Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Reddit.
And if you find our talks useful, please consider subscribing, like, and comment underneath.
All right, so this is going to be a fun one. We're diving into a company that, almost everyone knows as a user.
Oh, for sure.
But I think very few people have really reevaluated it as an investor, in the last 6 months or so. We're talking about Reddit, ticker RDDT.
Yeah.
And I have to say, looking at the research here, the earnings reports from late 2025, notes from Needham, the charts, this is just not the same company that went public a couple years ago.
It really isn't. For the longest time, Reddit was sort of the ugly duckling of social media stocks. It was where you went to, figure out why your printer wasn't working or argue about a movie ending. The whole story was always great culture, huge usage, but a terrible business.
Right.
But looking at these numbers, especially from Q3 2025, that story's just dead. It's gone.
It's completely buried. And I think the headline here, sort of the mission of this deep dive, is to really understand that pivot. We aren't looking at a social media company anymore.
What are we looking at then?
We're looking at a high-margin data powerhouse. It's a transition that kind of reminds me of when Adobe moved from selling software in a box to the cloud.
Or Netflix from DVDs to streaming.
Exactly. It's a fundamental shift in its identity.
Yeah.
And the market is, I think, just now waking up to it.
So let's start with what we're calling the hypergrowth phase. That's a term we hear a lot in tech, usually for companies just burning cash to get users.
Yeah, that's the stereotype.
But Reddit is doing something different. They've hit this operating leverage point, that is. It's honestly staggering.
Right. Let's start at the top line. Revenue hit $585 million.
In Q3 alone.
In Q3 alone. That is up 68% year over year. Now, for a platform that's been around for, 20 years, that kind of growth is just, it's unheard of.
It is. You see that from a startup, not, a legacy internet company.
Yeah.
But that revenue number, as impressive as it is, isn't even the thing that really jumped out at me. It's the profitability. I remember the IPO was all red ink.
Not anymore. Net profit came in at $163 million for the quarter, a massive swing from the losses they were posting.
Wow.
But, and I know you saw this because it's circled here, look at the gross margin.
91%. I had to double check that. I really thought it was a typo.
It is not a typo.
91% gross margin. Just to give you some context, social ad platforms are usually in the 60, maybe 70% range. 91% is. That's elite software territory. It's better than most SaaS companies. How are they doing that?
It's the mix shift. This is the secret sauce right here. Yes, they sell ads, and the ad business is booming. We'll get to that. But this margin expansion is all being driven by data licensing.
The AI angle.
Exactly.
Yeah.
Just think about the economics of it. If you sell an ad, there's friction.
Right. Cost to serve it, track it.
You have to host the video, track the clicks, report the metrics. There's a cost of goods sold. But data licensing, you're basically selling access to a library you've already built.
So the books are already on the shelves. You're just charging an entry fee to come in and read them.
A perfect way to put it. And the incremental cost of letting an AI company, like, say, OpenAI or Google, read those books is virtually zero. So almost every single dollar from those deals drops straight to the bottom line.
And that's where the 91% comes from.
That's it. They've turned their entire archive, the history of human conversation on the internet, into a high-margin product.
That's fascinating. It's like they discovered oil underneath a playground they built 20 years ago.
That's a perfect analogy. And it leads us right to the moat. We always ask, what stops a competitor from doing the same thing?
Yeah, if this data is so valuable, why doesn't, X or TikTok just start selling their data?
Well, this brings up the unique knowledge graph. The Needham analysts are calling Reddit's data uniquely valuable. And that word, unique, is the key. Because if you're training a large language model, an AI, you need human speech.
And the open web is just, it's a mess.
It's a disaster. It's full of spam, broken sentences, SEO bait articles that say nothing. It's just noise. And if you train an AI on garbage, you get garbage out.
Right. But Reddit is different. It's organized. You have communities, subreddits. If I go to a subreddit about, vintage motorcycles, I know the context. The data is pre-labeled.
And it's not just the labels. It's the upvote and downvote system. I think this is the piece Wall Street is just now really getting. That system is basically crowdsourced quality control.
It's millions of people sorting the data for you for free.
Yes. In the AI world, they call it reinforcement learning from human feedback. Companies usually pay people to sit there and grade AI answers. Reddit's had users doing it for 2 decades. They're telling the AI this is a good answer and this is a bad one.
So, okay, another analogy. If the open web is a giant pile of books in the middle of a gym,
Right.
Reddit is a library. Everything is shelved, categorized, and the best books are on a special display at the front.
Precisely. And that organization is what AI companies are paying for. It saves them a massive amount of time and computing power. They just can't get that quality of human conversation anywhere else.
Which creates a network effect, right? As the AI gets better using Reddit data, search engines get better, and that just drives more people back to Reddit.
It's a flywheel. More users ask questions, which creates more answers, which improves search results, which brings in more users. And for the communities, this creates really high switching costs.
Yeah, I was thinking about that. If you're deep into a niche hobby, say hydroponic gardening, you can't just move that group to Instagram.
The format doesn't work.
It doesn't work. The history, the guides from 5 years ago,
Uh-huh.
it's all locked into Reddit.
Exactly. You can copy the software for a forum in a weekend.
Yeah.
You cannot copy 20 years of community trust and shared history. That is a huge defensive moat.
But, we have to be careful not to get tunnel vision on just the AI stuff. I was looking at the ad revenue numbers, and I honestly expected them to be kind of flat.
You'd think so, right?
Yeah.
The legacy business usually stagnates.
Yeah, but no. The core ad business grew 74% last quarter.
74%.
And ads, that's outpacing Meta, it's outpacing Google. That's incredible.
It really is. It shows management hasn't taken their eye off the ball. They've rolled out better targeting, better self-serve tools. They're finally monetizing the intent of their users.
Right. Because if I'm on a subreddit about buying a new laptop, that is
Yeah.
high commercial intent. I'm there to spend money.
Exactly. And for years, Reddit was just terrible at showing you a laptop ad in that moment.
Mhm.
Now, they finally fixed the tech. So you have this dual engine running.
Hyper growth data and a rapidly growing ad business.
You got it.
So we've got growth, margins, a moat. Let's talk financial health, the balance sheet. Because high growth tech is often, fragile.
Reddit is the opposite. Their financial health is incredibly robust. Looking at the latest figures we have, assets are listed at $263 billion.
Wait, 263 billion? That seems massive.
It's a staggering figure in the report, and it likely reflects the immense valuation of their intangible data assets. But even if we just look at the ratios, they tell the story of safety. Look at the quick ratio.
Okay, remind us what the quick ratio is.
It measures your ability to pay off short-term debt with liquid assets, like cash. A ratio of 1 is considered safe.
So $1 of cash for every dollar you owe.
Right. Reddit's quick ratio is around 12.
12. So they have $12 of liquid cash for every $1 of bills coming due.
They're absolutely drowning in liquidity. It's exceptional. And their return on assets is a strong 24.9%. They are free cash flow positive, too.
And management has been clear, no dividends.
No dividends. And you don't want them to pay one, not when they're growing at 68%. You want them to pour every dollar back into the business.
Feed the beast while it's growing.
Exactly.
Okay, so the fundamentals are rock solid. Let's pivot to the stock itself. Today is January 20th, 2026. How's the market treating RDDT?
It's been a really strong run. The stock is currently trading in the 228 to 230 range. Now, the 52-week high was back in September 2025 at about 283.
So it's up about 36% over the last year, but it's pulled back a bit from the highs.
It has.
Is that a warning sign?
The technical analysts are seeing this as healthy, a consolidation. The stock sprinted up, and now it's just catching its breath. In fact, Stock Traders Daily just put out a note that's incredibly bullish. They're calculating a 96-to-1 risk-reward ratio at these levels.
96-to-1? I don't think I've ever heard a ratio that high. That implies almost no downside.
It's very aggressive, I know, but that's what their charts are saying. They're targeting a gain of about 28% from here. The signals suggest the stock has found a strong floor.
And what are the big banks on Wall Street saying?
It's pretty much a sea of buy ratings.
Yeah.
Needham just named Reddit their top pick for 2026.
Top pick. That's strong conviction.
It is. They put a $300 price target on it.
Yeah.
They think the market is still underestimating the data licensing deals. RBC also raised their target to 250.
Okay, so the chart looks good. Analysts love it. But my job is to play devil's advocate.
Of course.
I have to bring up the bear case. I saw the headlines in December. The COO, Jennifer Wong, sold a lot of stock.
Ah, yes.
Huh.
The insider's selling panic. It's the classic bear argument.
Well, it looks scary. When the COO sells over $9 million worth of stock, you start to wonder, does she know something we don't?
It's a valid question, but you have to look at the context. Yes, she sold about $9.18 million worth of stock, but this was a Rule 10b-5-1 transaction.
Okay, translate that for us.
It's a preset trading plan.
Okay.
It means that sale was scheduled months in advance back in May. She didn't just wake up in December and decide to dump her shares.
So it was automated.
It was automated diversification. And here's the kicker. She still holds over 1.18 million shares. That sale was just a fraction of her total holdings.
So she kept most of her skin in the game.
The vast majority. It's diversification, not a lack of faith.
Okay, that makes sense. What about the other big risk? Valuation. Is the stock just too expensive now?
It is not cheap. The forward PE ratio is around 68, maybe even higher depending on how you calculate it.
Ouch. 68 is steep.
It is. But you have to ask what you're paying for. In investing, you pay a premium for hypergrowth. If a company is growing at 15%, a 68 PE is insane.
Right.
But Reddit is growing revenue at 68% and profits even faster. The market is pricing in that growth continuing for years.
So they're betting today's expensive price will look cheap in a couple of years.
Exactly. It's the Amazon logic from the old days. It always looked expensive, but the growth always justified it.
Okay, so looking ahead then, what's on the calendar? What are the key dates to watch?
Earnings are right around the corner. We're expecting the next report on February 11th, potentially the 5th, but the 11th seems most likely.
And what's the expectation going into that?
Well, the company guided for revenue between $655 and $665 million. The consensus for earnings per share EPS is around 94 cents.
Which is a big number.
It is, but Reddit has established a pattern we'd love to see. Beat and raise. In Q3, they posted 80 cents when the street only expected 52.
So they have a habit of sandbagging their guidance, setting a low bar they can easily jump over.
That seems to be the game. Underpromise and overdeliver. So the market is quietly expecting another beat. If they just meet expectations, the stock might wobble. But if they crush it again,
We could see that $300 target pretty quick.
absolutely. And beyond the numbers, you have to watch for new partnership announcements. The rumor mill is always churning about undisclosed AI deals. If they drop news of another major data deal, that could be a huge catalyst.
So February 11th is the fireworks show.
It's the moment of truth.
Oh.
It'll tell us if Q3 was a one-off or the new normal.
Okay, so let's bring it all home. We've looked at the data pivot, the moat, the margins, the risks. Final verdict on Reddit.
If I had to score it, based on everything in front of us, I'm landing on a 9 out of 10 bullish score.
A 9 out of 10. Wow.
It's high, I know, but it's just hard to argue with the fundamentals. They figured out how to monetize their archive without destroying their community. They have a pristine balance sheet, massive liquidity, and ad growth that's outpacing the industry.
And that path to $300.
It looks clear. Between the chart momentum and the fundamental tailwinds, I think Needham's target is very realistic, assuming they execute on this next earnings report.
So the takeaway for everyone listening is, stop thinking of Reddit as just a place for cat memes.
And start thinking of it as a data mine. A data mine where the gold is already sorted, stacked, and verified by millions of humans.
And in an age where AI is creating more and more noise,
That human verification is becoming the most valuable commodity on Earth.
that is a powerful thought. As the internet gets flooded with AI content, the value of real human content actually goes up. Scarcity drives value. Well, there you have it. A deep look under the hood of RDDT. Keep an eye on that February 11th earnings date. Sounds like it's going to be a big one.
It certainly will be.
Thanks for listening to Smart Wealth with Joshua. We'll catch you on the next one.